Hi everyone, this is our final chapter, chapter 22. We are going to be looking at master budgets and planning. The first section we're going to look at is describing the benefits of budgeting. So when we're looking at this, we're looking at it from, again, the managerial perspective. So we have a few different parts that we're going to look at. First, let's talk about, why do we have a budget? What are the benefits of it? Why would we want to have it? Well, before we can talk about that, we need to talk about what is a budget, right? So a budget is actually going to be the financial plans for a company. So it can be a short-term plan. It can be a long-term plan. Typically, budgets are going to be a shorter time period, like a month or a year, maybe even a quarter. But budgets are going to be useful so that we can control our operations. They are actually one of the key managerial functions in the planning and control that we're going to look at. So in here we can see that we're going to look at different sections. Let's look at planning first. So what is a plan? It says here it focuses on future opportunities. So it is that. It does focus on future opportunities. It also looks at threats that happen with our organization. So the focus on the future is important because the daily pressures of operating an organization can divert management's attention from planning. Let's look at control next. It says that it provides a benchmark for evaluating performance. So that is true. We want the management to be able to evaluate operations against something normal. That normal is what we're going to consider to be a benchmark. So when we're thinking about this, budgeted performance considers important company, industry, and economic factors. We're also going to be looking at a comparison of actual to the budgeted performance so that we can provide an effective monitoring and control system. The next part at the top talks about coordination. So this is going to help us coordinate the activities so all the employees and all the departments understand the company's overall goals and we can all work toward that same goal. Next, we see communicate. Written budgets communicate management-specific action plans to all employees. So we want to make sure that everyone in the company understands what those plans should be. Then we see communicate. We want to make sure that the written budgets communicate management-specific action plans to all employees. So we want them to first coordinate it, help make sure that everyone understands it, and then we want to make sure that we communicate it to everyone in written format. And then lastly, we want to talk about motivating. So we want the employees throughout the company to participate in the budgeting process and include them in how we can establish the goals that we want to set and how do we get to those goals. The more you include someone, the more likely you are to see them have a buy-in to that goal. All right, so budgeting can have a few other factors. We want to look at not only the number part of it, but we have to remember this is a human behavior section too. So some of the things we want to make sure that can be looked at as positive are, how are the employees that are in the company going to be affected, and did we include them? Did we consult with them? Did we talk to them? Did we see how what we're doing is going to affect them? We want to make sure that the goals are challenging, but that they can be achieved. We don't want to set a goal that's so far out of reach that we're never going to hit it, because then that's going to decrease that motivation. If you know it's something that you can't get to, it's less likely you're going to work hard to get to that end goal. And then we want to look at evaluations. We want to make sure that they offer opportunities to explain differences between the actual and the budgeted amounts. So we want to look at them carefully and figure out what is the differences. Sometimes some of the negative side of letting people participate in budgeting, we may have employees that understate sales or overstate expenses to allow cushion, which is what they call budgetary stock or budgetary slack. So we want to avoid that. But it is one of the things that we can see. The other thing could be that we might have pressure to meet results, and that could lead employees to engage in unethical behavior or even report fraudulent information. And then lastly, we want to make sure that employees Some of the things that can happen is that employees might purchase unnecessary things just to make sure that they don't lose that money the next year. And this is something that actually happens pretty frequently. And I'll give you an example. So the state of Delaware has a budget that they give to every department. Well, I used to work at the Department of Insurance before teaching at Delaware Tech. And, we get to May, which is near the end of the year. For the state of Delaware, their year end is actually June 30th. So we get to May, the controller's looking at the budget. They're looking at what spending has happened during the year, and they see, wait a minute, we have some items that have a lot of extra money in it. And if we don't use it, they may say that we don't need it. So the next year, we're not going to get it. So they make sure that they spend that money, even though logically you would think, well, if you save it, then that saves the state overall. And that would be true. If that department felt that they would get the same funding the next year in case they did need it the next year, then they might be more likely to save it. But because the history has shown that if they don't spend it, the next year it's going to be taken from them. So they end up spending it on things they don't need just so that it's not reduced that next period. And that's pretty common. It happens all over the place. All right, so let's look at budgeting, reporting, and timing. When we think about this, it's usually going to go along with the end of periods. In this case, we see that it's, quarterly. It could be the end of the year, but budgets are going to be reported or prepared based off of the timing we have set. So there's usually an annual budget that we do to figure out where do we want to be for the year. And then that might be broken down into smaller parts, like a quarterly or a monthly budget. Those short-term budgets allow management to periodically evaluate performance and take corrective action before we get to the end of the year. Some companies use something called continuous budgeting, where they prepare rolling budgets. So when we do that, a company continuously revises its budget as time passes. So they might revise an entire set of budgets by adding a new quarterly budget to replace the quarter that just finished. So that's what we can see. Some companies do this. Some companies make a plan for the year and they stick to it. They just do the comparison of the actual to the year end. Every company is different, and it's up to those individual companies. All right, so let's look at some of the master budget components. When we think about master budgets, there's a lot of components that go into it. So the master budget is going to include individual budgets for sales, production. Sometimes it might be purchases instead of production, depending on the type of company, expenses, capital expenditures, and then also cash. So we can have all those different kinds. So the number and types of budgets included in a master budget depend on the company's size and how complex that company is set up to be. So if we have a manufacturer's master budget, it should include at least several operating budgets, a capital expenditures budget, and a cash budget. Capital expenditures budget is going to summarize the effects of the investing activities on cash and help determine the company's need for financing. Managers also often express the expected financial results of the planned activities with a budgeted balance sheet and a budgeted income statement. Some budgets are going to require us to get information from other budgets to be able to prepare them. So there is a sequence we have to do specific budgets in to get to the end result we want. All right, so let's look how to prepare the operating budget of a master budget for a manufacturing company. All right, so here we see that it starts out with a sales budget. And it shows us here that the first step in preparing the master budget is our sales budget. And that shows the planned sales, units, and the expected dollars from those sales. The sales budget is the starting point in the budgeting process because plans for most departments are linked to their sales. The sales budget is going to come from a careful analysis of forecasted economic and market conditions. We might look at business capacity, and we might look at what kind of advertising plans we have set up. To develop the sales budget, companies must estimate both unit sales and the selling price per unit. All right, so in this example, they show us In September 2019, Toronto Sticks Company sold 700 hockey sticks at $60 each. Toronto Sticks prepared the following sales budget for the next 3 months. So after considering sales predictions and market conditions, they prepared the sales budget for 3 months, and that's going to include forecasts of both unit sales and unit prices. So they were able to figure out where they wanted to be or where they estimated to be going forward. All right, next we have a production budget. So we're going to be looking at a production budget, which is going to show the number of units to be produced within a specific time period. So we see the general computation for the production required for a period here, and we start with a budgeted ending inventory. Then we are going to add the budgeted sales units for the period, which came from our sales budget. Remember I said there's some things that are going to come from other places, so we have to do it in a specific order. So once we have the information from the sales budget, that's going to give us the required units needed for the period. Then we subtract the number of units in the beginning inventory, and we're left with the total units to be produced in the period. So a production budget does not show our costs. It is always expressed in units of product. All right, so here's an example of that. And again, it's based on units of product. And we can see here an example of one. We have 3 steps we're going to use to complete a production budget. So the first is we have to compute the budgeted ending inventory based on the company's inventory policy. Then we're going to add our budgeted sales, which we get from the sales budget. And then we can subtract the beginning inventory. The result is going to be the required units to be produced for that period to meet the expected sales. All right, next we're going to look at a direct materials budget. So it's going to show the budgeted costs for the direct materials that need to be purchased to satisfy the amount of production we're going to have during that period. So we're going to be looking at a few different things. For a direct materials budget, we need to have the number of units to produce from the production budget. We need to have the materials requirements per unit. We need the budgeted ending inventory in units of direct materials, as well as the beginning inventory in units of direct materials, and the cost per unit of direct materials. So it's based on the budgeted production volume from the production budget. The direct materials budget for Toronto Sticks Company is shown on our screen here. So the direct materials budget is driven by the budgeted materials needed to satisfy each month's production requirement. So we can see here this budget begins with a budgeted production from the production budget. Next, Toronto Sticks Company needs to know the amount of direct materials needed for each of the units to be produced. In this case, it's a ½ pound of wood. With these two inputs, we can now compute the amount of direct materials needed for production. For example, if we want to produce 710 hockey sticks, we will need 355 pounds of wood. 710 times 0.5 pounds gives us 355. So it also tells us that Toronto Sticks Company wants to have a safety stock of direct materials on hand at the end of each month to complete 50% of the budgeted units to be produced in the next month. Since they expect to produce 1,340 units in November, that requires 670 pounds of materials. It's going to need ending inventory of direct materials of 335 pounds, 50% times 670, in inventory for the end of October. The direct materials requirements for October would be 690 pounds, the 355 plus 335. Since they already have 178 pounds of direct materials in the beginning inventory, it deducts that from the total materials requirement for the month. And then for October, we're going to have 690 pounds minus 178, so 512 is the number of pounds of direct material to be purchased in October. The direct materials budget next looks at the pounds of direct materials to be purchased into budgeted cost. We estimate the cost of direct materials to be $20 per pound over the quarter. At $20 per pound, purchasing 512 pounds of direct materials, we will have a cost of $10,240. So that's just the October one. Let's look at the next section in our next video.